Welcome to our latest explainer. Okay, let's dive into this. Today, we're going to look way past the familiar financial world that you and I navigate every single day. We're peeling back the layers to reveal a massive, hidden secret operating right underneath all of it.
So who is really financing the economy? It seems like a pretty simple question, right? But the answer? Well, the answer requires us to take a completely different approach to how we view modern finance. This isn't going to be your standard run-of-the-mill briefing. We're treating this like a full-blown financial investigation. We need to look past the neon signs of the high street banks and really dig into the actual nuts and bolts mechanics of where credit comes from in the modern era.
To kick off this investigation, we've got to start with the financial system you already know. Think about a simple everyday action. Let's say a customer deposits £10,000 into their standard checking or savings account. Now that £10,000, that is the absolute foundation of traditional banking. A lot of people kind of intuitively picture the bank taking that physical cash, walking it down into some giant steel vault, and just locking it away for safekeeping until the customer wants it back. But you know what? That is not how the system works at all.
Instead of locking those deposits away, banks put that money to work. They use their balance sheets to provide the vital loans that keep households and businesses running. That £10,000 deposit, combined with thousands of others just like it, gets transformed. It becomes the mortgages that buy our homes, the auto loans for our cars, business loans to help local shops expand, and even commercial real estate loans to build brand new offices. The bank is carefully managing its liquidity and dealing with incredibly strict regulatory requirements just to make sure it can fund all these loans while still keeping enough cash on hand for the depositors.
And this brilliantly illustrates the classic traditional model of financial intermediation. It's basically three straightforward steps. The depositor puts the money in, the bank holds the center, and the borrower takes the loan. The commercial bank sits squarely right in the middle of this relationship. They manage all the interactions with the borrower, they do the underwriting, and crucially, they take on the credit risk. If the borrower defaults, well, the bank is the one on the hook. It's a very clear, highly visible, and highly regulated straight line.
But over time, the financial system became much, much larger than the banks most people could actually see. You see, businesses still absolutely needed financing to grow, and consumers still needed mortgages to buy homes. But as the global economy expanded, traditional commercial banks were no longer the only ones providing that credit. A vast, quiet shift occurred, moving literally trillions of dollars in lending away from those familiar bank branches and into a completely parallel universe of finance.
So if the deposits from our everyday checking accounts aren't the only things funding these loans anymore, where exactly is all this money coming from? Well, it comes from massive parallel sources of capital. We're talking about the pension funds managing your retirement savings, giant insurance companies, university endowments, wealthy family offices, and some highly complex institutional investors. These entities have trillions of dollars in capital, and just like a traditional bank, they want to deploy that capital to earn a return by providing financing. To see how this actually plays out in the real world, imagine a mid-sized manufacturing company that needs, say, £10 million to expand its factories and hire some new workers. Historically, they'd go straight to their commercial bank, but today, that company might completely bypass the traditional banking system. Instead, they could receive that £10 million financing through a private credit fund or another non-bank lender. The credit still flows, the factory still gets built, but a traditional bank was just never involved in the transaction.
Now, what's really interesting about this slide is how massive the differences are when you compare these two models side by side. On the traditional banking path, capital flows from everyday depositors to commercial banks and then into loans. But on the parallel non-bank path, it flows from institutional investors to private funds and then into private credit. They differ in where the capital originates, who is actually taking on the credit risk, how the institutions are funded and regulated, and ultimately exactly who absorbs the losses if a loan goes bad.
But here's an absolutely critical detail. You really shouldn't look at these as two completely isolated, separate worlds. Traditional banks and non-bank financial institutions are deeply, intricately tangled together. For instance, a commercial bank might provide a massive credit facility to a private non-bank lender, or they might buy securities bundled by an investment fund. Through lending relationships, securitization, and complex asset management, the visible banking system and the invisible parallel system are constantly interacting and are heavily dependent on one another.
Because this parallel system operates mostly outside the standard view, it's earned a rather dramatic nickname. Researchers and regulators call it shadow banking. Now let's bust a major myth right here and now. The word shadow does not mean illegal activity. It doesn't mean secret criminal organizations or nefarious plots. Shadow simply means unseen. It just refers to credit intermediation happening outside the traditional, heavily regulated commercial banking framework. You might know exactly who your bank is, but you likely have no idea which investment fund actually owns the underlying debt of your auto loan. Which leads us to the ultimate investigative question. What happens when the borrower cannot repay? In the traditional banking system, there are immense safety nets. There are strict bank capital requirements, there's deposit insurance to protect your checking account, and there are central bank facilities that can step in during a crisis. But in the shadow banking system, the funding structures and risk-sharing mechanisms are completely different. There is no standard deposit insurance for an institutional investor in a private credit fund.
So the crucial point is that we cannot just label non-bank finance as automatically more dangerous. It serves a very vital economic purpose. However, to truly understand financial stability, we have to look closely at three key issues. Where does the risk sit? Who actually holds that risk when a loan defaults? And because of how deeply interconnected these systems are, how easily can that risk spread from an unseen private fund directly into the traditional banks that hold our everyday deposits?
To answer those questions, we have to move beyond just explaining the structure and really start investigating the mechanics. And in any financial investigation, there's really only one golden rule that bridges everything together: follow the money. We need to identify exactly how credit, liquidity, and risk physically move through this parallel network.
Let's move to and see how this builds, tracing a single dollar through this invisible machinery. First, it starts with the investors, maybe a pension fund holding your retirement savings. Second, that becomes institutional capital. Third, it gets deployed into a non-bank investment fund. Fourth, that fund makes a loan to a business. Fifth, the business generates revenue for borrower repayment. And finally, step 6, that money flows all the way back as investor returns. It's an incredibly efficient loop happening entirely outside a traditional bank.
But this efficiency brings us right to the central dilemma faced by regulators and economists around the world today. Does having more sources of credit make the financial system stronger and more resilient? Or does it create hidden risks that are simply harder to see until it's too late? This is the core debate of modern finance. To view this completely objectively, we can map out both sides. On the one hand, the potential benefits are massive. You've got additional sources of credit, more options for growing businesses, increased competition, and access to capital for borrowers who just don't fit the rigid molds of traditional banks. But on the other hand, the potential concerns are serious areas of investigation: high leverage, severe liquidity risk during a panic, much less market transparency, incredibly complex interconnectedness, and valuation uncertainty when private assets are just hard to price. It is a very delicate, high-stakes balance. To truly understand this balance, our explainer is going to embark on a deep dive. In our upcoming chapters, we'll be mapping out everything from the origins of private credit and the haunting lessons of the 2008 crisis, to the interconnectedness of these two financial worlds and exactly where future stress might hide. Which brings us to a final, provocative thought. If the visible financial system is only a fraction of what finances our economy, what happens when the massive, intertwined part we cannot see comes under sudden, severe stress? Think about that as we prepare for our next investigation.